Even after everything that happened the past few months, the S&P 500 is currently up 6.4% since the start of 2025. And that's after crashing as much as 19% from its highs in April, making an incredibly fast recovery. And yet, you may be surprised to hear that if you're holding an S&P 500 ETF in your portfolio in Europe, as your brokerage account likely still shows it being down 8%. The same goes for world ETFs like the popular MSCI World or FTSE All World. These are also still around 4% in the red, even though US stocks make up around 60 to 70% of them based on their market cap. Which is why I've seen more and more Reddit posts like this one by European investors lately wondering what's going on. So let's explore why this is happening, if currency hedging makes any sense as a European, and take a closer look at how my own investment portfolio has been performing lately. Let's just say things could definitely be better. Okay, so let's start with what the market has been up to. Do you remember how crazy everything got after the ridiculous US tariff announcement in April? At its low, the S&P 500 had fallen as much as 19% in value from the highs. World stock indices like the MSCI World or FTSE All World also didn't fare much better at the time. And now, just 3 months later, the S&P 500 is actually up 6% for the year, meaning it rallied 25% since then. What an incredible V-shaped recovery. Then again, it has to be said that we weren't dealing with an actual market crisis. This crash was self-inflicted by trade policy announcements, many of which have since been rolled back. And it probably helped that the earnings of many US tech giants have been better than expected so far. However, if you're a European investor like myself and you look at your portfolio, you're likely still down quite a bit in euros this year, around 7% if you're holding an S&P 500 ETF, and around 4% if you're holding the FTSE All World, which is leading more and more Europeans to create posts like this on Reddit. Is FWCE, the Vanguard FTSE All World, decoupling from the S&P 500? With S&P 500 at all-time high, I noticed FWCE, second largest part of my portfolio, trailing behind quite a bit, currently 8 to 10% depending on how you look. Any idea what is happening? The S&P 500 represents the majority of FWCE, so the only logical conclusion would be that the rest of the indices are tanking, but looking at the stock 600 and other relevant ones, they are all near all-time high. The second explanation would be USD devaluation, but FWCE is nominated in US dollars and not euros or something else, so that's not the reason either. Any ideas? He's referring to the USD part you see in the name when buying the ETF from most brokers, which is simply the internal fund currency, even though we're able to trade it in euros. And another post, I invest my savings in SXR8, the iShares S&P 500 ETF. I have never doubted my investment, however I've been questioning some things lately. A few days ago I saw everyone saying that the S&P is at an all-time high. I couldn't believe it because I remembered buying some ETFs at 600 plus euros and now it's at like 560. Overall, I didn't lose much money since I invest regularly and I invested mostly below 550, but it made me question my investments. I never thought about the currency fluctuations and I was also thinking my ETF may not be affected since it's domiciled in Ireland. As you probably guessed based on the last sentence, the reason you see this difference in returns is because of the USD to Euro exchange rate. Currency fluctuations are completely normal, but this year has been particularly rough for investors in the Eurozone. Since the start of 2025, the US dollar has lost over 12% in value against the euro. Let's see the last time this happened. From October 2022 to May 2023, it dropped over 13%. April 2020 to January 2021, minus 11.5%. And as much as 13.7% from March 2017 to 2018. Obviously, the reverse also happens on a regular basis, with one notable recent example being May 2021 to October 2022, where the dollar gained over 25% against the euro. But getting back to where we are now and the most recent drop, it means that any USD denominated asset like US stocks also lost 12% in value because of the exchange rate, turning what would have been a 6% return in USD on the S&P 500 in 2025 into an 8% loss, or an even more impressive plus 10% return in the FTSE All World in USD into a 3.8% loss in euros. As you can see, the stock market has actually been doing pretty well this year despite all the chaos. It was simply overshadowed by the US dollar's weakness compared to the euro, and there were plenty of periods where we profited from the opposite, the US dollar getting stronger, even recently. In 2024, it added 7 percentage points to our returns from the FTSE All World in euros. It reduced our losses by 5% in 2022, and we saw as much as 10 percentage points better returns in 2021 compared to US investors in their local currency. Even going back to the Vanguard FTSE All World ETF's inception, in this case the older distributing version from 2012, we've profited quite a bit from the euro's weakness compared to the dollar overall. As you can see, it's completely normal for this to shift on a year-by-year basis. Sometimes it will be good for us, other times it will affect our investments negatively. And for those of you that were surprised by the differences in returns due to USD being in the ETF's title, that's simply because it ETFs tend to use the US dollar as their fund currency when US stocks make up a large percentage of them, as is the case with the FTSE All World, MSCI World, or entirely with the S&P 500. If you're, however, buying and selling them directly in euros on most European brokers, like my favorite Interactive Brokers, link down below if you'd like to support me, then you'll also see returns in euros, not US dollars as US investors would. And it doesn't matter what currency you trade the ETF in or what the fund currency is, your returns in euros will be the exact same. That is, of course, unless you buy a euro hedged ETF. Now, based on what happened this year, you may be wondering if it makes sense to do that. But when you compare the performance of world ETFs, it quickly becomes clear that currency hedging rarely works in your favor, especially if you're investing for the long term. Take the iShares Core MSCI World ETF as an example. On the left, you have the standard unhedged version with an annual expense ratio of 0.2%, and on the right, the euro hedged version with internal cost of 0.3% per year. Before we compare their returns, I just wanted to point out that Just ETF always shows a total return including dividends. So it doesn't matter that the hedged version is distributing instead of accumulating. This came up in the comments last time, so I just wanted to quickly clarify it. Anyway, with only a 0.1% difference in fees, you'd expect the performance to be nearly identical, right? Unfortunately, that's not how it plays out, with the normal unhedged version beating the hedged ETF by 12 percentage points since June 2019. But to see how much hedging actually costs us, we need to strip out exchange rate effects and look at the returns of both in US dollars. Sadly, the hedged version still underperformed by almost 13 percentage points in 6 years, which is way more than a 0.1% difference in yearly fees would let you believe. As you can see, hedging is very expensive and unlikely to be a good idea for passive long-term investors in stocks from all across the world. In my opinion, it would only make sense if you're 100% certain that the euro is going to rise in value over the long run against the US dollar and other major currencies that play a role in global stock indices, which I personally seriously doubt based on all the problems we have to deal with ourselves here in the Eurozone. Okay, now let's see how the ETF portfolio I shared with my wife has been affected by everything that happened so far this year. While we've been able to recover quite a bit since the lows in April, we're still down about 4.3% or 20,700 euros since the start of the year. As for our average yearly return since we started investing in 2017, that's currently standing at a respectable 10.39% per year. As you probably guessed, our investment strategy remains as boring as ever. We just buy a single global ETF every single month with 90% of our monthly savings, the accumulating Invesco FTSE All World. We've continued doing that throughout all of the global chaos since April, as we always do, no matter what the news headlines are trying to scare us with at any point in time. The same goes for our much smaller speculative 10% allocation to Bitcoin, which would have been up 14% in US dollars year to date, but basically moved nowhere in euros due to the exchange rate. I am nonetheless feeling very bullish about Bitcoin for the rest of the year, as I am for our ETFs. Look, it obviously sucks to see most of our portfolio in the red due to currency fluctuations, but as I've shown you today, there have been countless other years where we've profited from them instead, and hedging is likely to be a big waste of money over the long run when investing globally. Since I live in Austria and make most of my money in euros, I actually appreciate the fact that an ETF like the FTSE All World not only enables me to diversify over thousands of stocks from all across the world, but also gain exposure to many other currencies globally. While you may be disappointed by this year's returns so far, I choose to remain positive and view it this way. First, while our net worth has remained pretty flat in euros, if we look at it in US dollars, it has actually gone up quite a bit in 2025. And second, the euro strength means we're able to buy more shares of our ETF or US stocks compared to someone living in the US making the exact same amount of money as they did half a year ago. This scenario is unlikely to last forever, so let's enjoy this opportunity while we have it. How about that for a mindset shift? If you enjoyed the video and you'd like to support me, feel free to use my links to my favorite local brokers in Europe for ETFs in the description below, as I don't do sponsors. And if you want to find out why looking poor or average is actually a smart idea while living in Europe, you need to watch this video next. Please don't forget that none of what I mentioned today was meant as investment advice. I'm just openly sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching. Have a wonderful week, and until next time.